And good afternoon. I am Randy Price. He is Matt Price. We are the Price Group. And welcome to the September monthly market update. As I was sitting here thinking, there's about 3 months till Christmas, which doesn't seem possible. Here we go to close out the third quarter and move into the fourth quarter with some news to report today from the Federal Reserve. But let's go ahead and get started as we always do. Please feel free to use the button at the bottom to ask us a question or email. We try to run on time to where this is 20 minutes or so, and we make good use of your time. And getting started here, we are the Price Group, and family owned and operated. 50 plus years of experience. I think one of the most important things, and one of the things that excites us, gets us up in the morning, is the ability to be a true fiduciary to our clients, sit on the same side of the table and do what is right for them. It's a higher calling, and we work in the retirement area. 83% or more of our clients are either going to be retired or retiring, and we feel like it's a real niche, and we are tickled to be here, and glad that you have the time to join us.
So looks like we got quite a few clients on the phone, a few that are not clients. Just as a way of background, a few awards that we've been awarded over the past few years from Barron's, Forbes, Financial Times. We have 3 certified financial planners on the team. Randy and I both went to the Wharton School of Business to get our CIMA Certified Investment Management Analyst designation. That's a mouthful. And if you're not on our weekly email, the Retirement Insider, we'd love to add you. So just shoot me an email and we can get you added on that front. But Steward Partners, the firm, based off the biblical definition of stewardship, our primary custodian being Raymond James. Custodian, just a word, fancy word for where client assets are held. They're one of our vendors. They've been a good partner over the years, a very fiscally conservative company, which we do appreciate.
Matt, I might mention, if you want to just jump back there, these figures, facts and figures, as of December 31st, 2023, 30 plus billion. When Matt and I joined in 18, Steward Partners was about 7 billion, and we're knocking on the door of almost 38 billion. So anyway, the concept, the company have all proven to be in the right place at the right time. So the Federal Reserve, if you haven't turned on the news, the Federal Reserve gave the economy a gift, we think, from a standpoint of cutting interest rates. And I say I think because anytime the Fed makes a change, some people are happy and some people are not. It sort of reminds me of golf. I've got a friend who says every putt makes somebody happy, but the economy remains a top issue for voters. And I think a little bit of that is wondering, wow, did we really need to cut 50 basis points or 0.5% today? But the Federal Reserve did cut short-term interest rates, which means money market rates will come down, and that will filter down into other loan rates of interest, et cetera. But the top issues for voters, inflation and prices. We're going to talk a little bit about that, jobs, the economy, immigration, healthcare. The gross domestic product, the measure of all goods and services, is anticipating to slow in the second half of 2024. You can see there for the third quarter, the experts out there are expecting 1%, a little bit less than that for the fourth quarter. But you may say, well, everybody's been talking about recession. Where is the recession? A recession is 2 straight quarters where the gross domestic product shrinks. We're not seeing that, and so maybe we do have that proverbial soft landing, but it doesn't look like for now that the inflation is in the cards, at least for the rest of 2024. So talking more about the Federal Reserve, affectionately known as the Fed, what will the Federal Reserve do going forward? Well, you see there on the left, the measure of the 3-month annualized inflation rate. And what's happening is inflation is declining faster than anticipated. Core inflation going forward should be about 2.6%. Also, with the Fed making the move, the labor market, we see some weakening there. Unemployment should be up to about 4.4% by the year end. And for what it's worth, there's a forecast for the Federal Reserve. The market implied, and that's from using futures rates and what the people that use futures to hedge are doing. And then the dotted line is the Raymond James forecast. So a lot of people are feeling like the Fed will cut some more rates. We've been talking about if you've got a lot of money in money market, it's current yielding over 5. I think you can wave goodbye to the 5%. And again, 4% certainly not bad after almost zero interest rates for a long period of time, but that has implications all of its own.
A little bit of review for the second quarter of earnings. We got 5 takeaways here. Randy already kind of touched on the 5th one. The Fed interest rate cuts are needed. What I want to focus on is number 2 there on the list. The earnings growth is broadening out. What do we mean by that? Here, historically, we've seen a very, what we call a narrow market. So earnings have been really spectacular for a number of growth companies. They've been referred to as the Magnificent Seven or the top 10 largest companies in the S&P 500. And we've seen the earnings kind of spread out, which is typically a sign of a healthy market. We've written a few blogs here recently talking about how we actually like the companies that are not in the top 10. So call it the other 490 stocks in the S&P 500. So all things being equal, we like to see healthy earnings spread across the entire market, not in a real narrow, concentrated piece of it. We've been thinking for a while, and the data has confirmed that the consumer is slowing down, so spending less than they have been historically, but we don't think there's a real stall or a stop of consumer spending here in the short term. And to follow up on that point, you can see here on the left, the earnings growth is a little bit broader. Something of interest, 9 out of the 11 sectors posted positive earnings growth, which is the most since the fourth quarter of 2021. So like we said, it's a real broadening we haven't seen in a couple of years, which is a good thing. Now, where do earnings go from here is we think a equally, if not more important question. We think that we're in that kind of mid to upper single digit range of earnings growth. And hopefully I didn't lose you in kind of this earnings jargon. Take a step back to look at the forest opposed to the trees. What makes stocks go up? Earnings go up. What makes stocks go down? Earnings go down. Warren Buffett has a famous saying. He says, everything else is just noise. Now, while that's a true statement, the noise can be there for a prolonged period of time. But if companies can continue to increase earnings, over time, stock prices will move higher. And so that's why we pay attention to this and what we can see really well what's happened in the past. We're more interested in what we think will happen in the future. We think kind of slow and steady, that middle to high single digit returns, 5, 6, maybe 7% earnings growth here moving forward.
So what does the Federal Reserve, what do the Federal Reserve changes or the change made today mean to you? We're going to run through here quickly on sequence of returns. Many of you have perhaps seen this chart, 4 boxes. Let's pay attention to the 2 boxes on the left. When a person is working, the rate of return that they get in their 401k or their retirement account does not mean anything because you're not withdrawing any money. And we prove that by taking a year 1 negative return of 15% and a positive year 10 return of 29%. The 29% is green, positive. And you start with 100,000 and you end up with $188,399. On the right 2 boxes, you're now retired. Congratulations. And you start a distribution from this account. And what you see is the sensitivity of the account to a change in the market value when you have a negative return in stocks. And we will absolutely guarantee you that there's going to be negative years in the stock market. Unfortunately, none of us know exactly when, but in the first top or on the right-hand box, if we again start with the same negative 15% in year 1 and then have a 29% positive in year 10, unfortunately, you've run out of money. In the bottom right hand, again, you get a return of 29% positive in year 1, and then a negative 15% in year 10. It works out much better for you. So that's why we think that what's happening with the Federal Reserve and what's happening with your individual portfolio is so important, because retirement is all about income. And so our goal is to create income, our goal is to increase the income, and our goal is to preserve the income. And preserve is a word that we're using now more with money market rates starting to move lower. Money market at 5% was pretty nice. It was higher than the long-term interest rates. Money market doesn't fluctuate. And at one point, we're getting 5.3, 5.4 on the money market. Now, we're going to see money market rates go below that. And if the Fed keeps cutting, maybe you get into where money market is 3%. Still a lot better than 0. But again, how your fixed income portfolio is positioned, we think is now increasingly critical when you talk about income over the next 3 to 5 years. So the hidden tax in retirement is inflation. Many of you have heard us talk about the rule of 72. It tells you how long it will take either your investment to double or the cost of living to double. For example, if you have 2% inflation, 2 into 72 is 36. Inflation will double the cost of living in 36 years. No big deal, right? But if you get 12% inflation, 12 into 72 is 6. And you get a doubling of prices of inflation, if you will, every 6 years. You can count out the number of times that could happen in your lifetime, and you see how sensitive the world can be to very high hyperinflation rates. Go back and read about Argentina and some of the other countries that had real problems on that. The Fed is supposedly aiming for an inflation of about 2%. And again, they raised rates to slow the economy down, and now they are dropping rates to speed the economy up. But inflation, unfortunately, was the problem of keeping rates low for so long, and the consumer, especially the person that is on fixed income, is suffering the consequences of seeing prices go up dramatically in a couple-year period of time.
So interest rates, a big deal. We also thought it'd be helpful, haven't talked about this in quite a few monthly market updates. We think that the best type of offense is actually a defense in retirement. Win by not losing is a term that Randy and I and Maddie use frequently. What we're looking at here is the rate of return needed to get back to break even after a specific loss in your portfolio. So let's look at your portfolio being down 20%. Intuition might lead you to believe that you only need 20% to get back to break even. But when you're taking 4% out of the portfolio and have 3% inflation, with a 20% downturn in your portfolio, you actually need 36% to get back to break even. So our goal is, yes, let's produce income, but also let's try to position the investment portfolio in retirement to maybe dampen a little of that volatility on the downside, not if, but when, like Randy said, markets do move lower. So a big piece of that is on the stock side. What type of stocks do you own? There's really 2 ways to look at the world, we think, as it pertains to stock investing. You're a growth-oriented investor, or you're an income-oriented investor. And both are very adequate while you're still working, We tend to favor the dividend paying stocks though in retirement, because rule number one in retirement, produce income. Rule number two is, let's refer back to rule number one, produce income. Here's a look at why we think dividend income matters. The royal blue piece is the percentage of the total return being income plus the growth by decade. And what you can see here is some quarter or some decades, it's in the teens, in the 20s, 30s, one in the 40s, one in the 60s. The long-term average dating back to World War II actually is round numbers about 40% of the total return comes from dividends. So 40% is not a rounding error. We think it's a real material number, and because clients do need reoccurring income from their portfolio, it's one of the ways that we generate this reoccurring income for clients.
So what does all this mean? It means that especially in times of change, the Federal Reserve increasing interest rates, the Federal Reserve cutting interest rates, it's a great time to really take stock of where you are. We talk about the need for a wealth coach, and we are firmly convinced that everyone does need a wealth coach. One of Warren Buffett's mentors, a guy named Benjamin Graham, had a quote that we really liked. The best way to measure your investing success is not by you beating the market, by whether you've put in place a financial plan. And this next one is very important, a behavioral discipline that are likely to get you where you want to go. So that's what we are all about here at the Price Group, getting you from here to there. There is defined as age 92. And we are big believers in holistic planning, taking into account not just the investments, but the tax planning, the estate planning, the cash flow, the insurance, goals, dreams, aspirations, etc. And so that's where we feel like one of our secret sauces is for our clients. So if that's of interest, something that you've not done or something that you've sort of had on the list to get around to, we would welcome an opportunity to sit down with you. We talk to folks on a regular basis. We tell them there's not a cost or an obligation, and if there's common ground, we'll both know it. If not, we'll shake hands, part as friends, and we promise you'll leave as a better educated consumer than when you walked in the door. So contact information there, picture there, that's Preston, Tiffany, Maddie, myself, Matt, and Melissa, with email addresses and such. Again, we are the Price Group. We do this on a monthly basis. I think most of you are already on our email list, but if for some reason you are tuning in and not on our email list, make sure you do that. We push an email out every Monday morning for folks that wish to get a brief, objective, with clarity look at where the world is. So again, we appreciate your time. Matthew, any questions before we go?
None so far. Shoot us an email if you have any, and we'll look forward to hopefully catching up soon.
Okay, be October before you know it. Again, thank you for your time. Have a great Wednesday, and hope to talk soon. Thanks so very much.
Thank you, guys.